There is a huge problem with all of the ICT daily bias videos out there at the moment, and no one's talking about it. And in today's video, I'm going to expose the way that this guy, this guy, this guy, and even this guy, yes, trades the daily bias. And then I'm going to show you my extremely stupidly simple way of finding the daily bias so that you can have higher win rates with your lower time frame entries. I'm Ethan Garland, and I spent about 5 years trying to become a profitable day trader. A lot like you watching this video right now. And man, it was fucking hard. All right, I'm not gonna sugarcoat it. But in the last 2 years, I started to find an edge in the market. And because of this, I managed to withdraw over $100,000 with prop firms, much of which I documented on this channel already. And my goal with this whole YouTube channel is to try and educate you guys on the real, proper, no bullshit way of trading so that you too can have the best chance at success. So while I look up to a lot of the people that I'm about to mention in this video, I have identified the biggest problem with the way that they determine ICT's daily bias. And so the problem can pretty much be narrowed down to one word: discretion. Now, the word discretion is defined in the Oxford Dictionary as the freedom to decide what the outcome of a particular situation will be. And I'm sure you guys know by now, but the biggest problem that traders face are controlling emotions. Now, how many of you get emotional when you're trying to make a really large, important decision? What if there were thousands of dollars hanging off the back of that decision? Pretty sure you'd feel all kinds of emotions, right? And so, as you can see, the link between your emotional issue with trading and the way that you can deal with that is limiting your options with trading and making your trading as discretionless as possible. Now, trading will never be without discretion, but you can limit your options to therefore allow yourself to be in a better, more logical state of mind so that you can make the best trading decision possible. But it's easier said than done, right? So let me show you the simple strategy that I use to define the daily bias and how accurate it truly is. Don't be fooled by how simple it is. In fact, it's only 2 different steps, and then we've got 2 different time frames that we traded on. Like I said, just because it's simple doesn't mean it's not accurate. Have a look at how it works, and then I'll show you how accurate it is in determining the daily bias. Right, so the first step is to identify ranges. Now, of course, we got bullish ranges and bearish ranges. Now, how I classify a range is simple. It is an impulse and a retracement. Impulse, retracement, okay? So that's literally the first step, and that's how simple it is. Of course, in a bearish example, you've got an impulse, retracement, impulse, retracement, impulse, retracement, okay? And so it continues. Now, how do I know if the market is trending? Simple. There are multiple impulses and retracements, okay? So step number 2 is to identify 2 impulse and retracements to the same direction. So now for me to identify 2 ranges to the upside, all I'm looking for again, impulse, retracement, impulse that breaks structure, okay? Let me draw that out a bit clearer. Impulse that breaks structure. We then retrace once again, and then an impulse that breaks structure again. Now we've got, okay, we have 1, 2 breaks to the upside, okay? And our ranges are simple. It is from the low of the previous, after the low that broke structure, the most recent low to the most recent swing high, like so. So we've got 2 ranges and 2 breaks of structure to the upside. And so we can then hypothesize that we are bullish. Now, what are we expecting to happen next? Simple. We're expecting a retracement followed by an impulse, okay? That is the most likely thing to happen next. Now, something else could also happen. We could also have price take out this swing low here and then continue. That's the second most likely thing to happen. Okay, now the next thing that could happen is we could take out the low here, which is one break and one impulse. Okay, we then retrace, creating the range, and then impulse to the downside again. What do we have now? We have a second break to the downside, okay? So we then can confirm that our bias is now bearish. So we've got one break to the downside and a second break to the downside. We can then confirm that price is bearish, and what's likely to happen next is a retracement and an impulse, okay? Now what could happen, like I said, again, price could retrace, take out the high as a liquidity point, at which point we are still bearish. We have not yet switched bullish, okay, because this is more than likely a liquidity grab that then continues lower. So within this leg of price, we are still only looking for sell trades, okay? So you can see how easy and simple that is, guys. We're simply looking for two breaks to the upside or two breaks to the downside to then confirm bias. And we're only using two time frames. For me, that's the 4 hour and the 15 minute. You can use whichever time frames you prefer, whether it be the daily and the 4 hour, whether it be the 1 hour and the 5 minute. It doesn't matter as long as one is a higher time frame and the other is a lower time frame. That is how I then line up my biases on those two time frames and have extremely high probability trades on the lower time frames. And you can understand that when you line up these two biases, you can then have a much higher win rate because of this bias. All right, so let me show you with real data and real chart. So let me go over the real actual chart and show you this in action real quick and how accurate it actually is. So I'm going to go back to a random part in time on the US 500 chart. I like to trade the S&P 500 because it is a trending asset. And of course, we want to trade with the trend. And these pairs and indexes, they trend. They tend to trend nicely, which gives us a lot of setups. So I'm now going to identify where my last breaks of structure were. In terms of swing structure. So as we can see, we took out the low right here to the downside, which again would then be our first break. We then have a second break after the retracement. So again, what does that look like? It looks like the drawing I drew before. An impulse, retracement, impulse, and a retracement. So we are now bearish, okay? What did we have after that? We had a price, impulse, and take out the high here, okay, of that previous retracement. So we only had only one break to the upside. Now, what can I hypothesize? Because we are only one break to the upside, we are still bearish in nature. So if we have a retracement here and then an impulse, I can then hypothesize that we are bullish. Okay, we've then switched back to bullish bias. So let's see what happens next. Okay, so again, we could classify this over here. Let me just find my tool. We could then classify this here as a retracement and a continuation. But if we look at this as a retracement, okay, I personally would not take that as a retracement, because if we look at previous retracements, for example, this one here, it's not even half of that. And so for me, that is more of a internal correction, okay? So that's where a little bit of discretion is involved. But other than that, this is extremely mechanical. So we've had price, then impulse. Okay, we've had a significant retracement here at least. So price really impulsed and then retraced here and then continued up. So we've had one break to the upside, and then we've had a retracement once again with a second break. Okay, so because we've had two breaks, I can now confirm our bullish bias. Okay, so let's see what price does next. We then take out the low here, okay, And once again, I would still be bullish at this point, okay? Because this, in my eyes, is still quite a bullish move, and we've only taken out one low, okay? We need price to retrace again and then take out the low again, which is exactly what it did, okay? So here the price took out the low once again. So we've had how many? 1 and 2 breaks to the downside, okay? So that means that I'm now bearish in nature, okay? What does price do? It then continues that trend. So you guys can see how accurate that actually is. So we had price take out once, retrace, take out a second time, and then what do we expect price to do? Because our bias is bearish, we would then expect price to retrace and take out the lows once again and continue that pattern. And that's exactly what it did in that instance. Now price is retracing once again, and it takes out the high. So we've had one break of the high, okay? And we've had a small retracement right here. Okay, so I would then classify that as 2 breaks to the upside. We had this as a second break to the upside. Okay, so we are now bullish. We've changed our bias. And so what I'm expecting price to do is retrace and continue this further. And that's exactly what it did right here, okay? It retraced and continued further and then started to go lower, okay? Once again, I have not confirmed a bearish bias because we need to wait for a retracement, which happened there, and we continue that bearish bias. So we've had one break to the downside here and a second break to the downside right here, okay? Now, what am I expecting price to do? It's gonna do one of 3 things. It's gonna retrace and continue lower, which is the most probable thing, or it's gonna take out the high right here and then continue lower. But the third thing it could do is take out the high, retrace, and take out the high once again, switching bullish, okay? Now again, we would then be lining up the 15-minute with this particular bias, and that is the most high probability that we can have, okay? So we don't only rely on this, we rely on our high time frame and our medium time frame. And then you can take trades on the low time frame, which are then much more high win rates, okay? So there we took the highs, okay? And we continued. So the third scenario happened. We took the highs out once, we retraced a little here and continued upward. So I am now bullish, okay, in bias. It is continuing to move in a bullish way. Okay, not a significant enough retracement here for me. Okay, so there you go. We had price push up, retrace, and push up once again. Okay, so we're continuing the bullish momentum, and my bias is still bullish. Okay, there is the retrace and the break. Okay. And the strategy that I trade is not my own strategy. I learned it from a different community. So if you want to learn from that community, the link is also in the description below. So once again, we're waiting for the lows to be taken out, which it happens with this move right here. We take out the lows, which would be this here. This was the most recent break here. And so this was the low that was of that break, okay? We then wait for price to retrace and take out the lows. So we're currently in a range. So what did price decide to do? It decided to do the second scenario that I speak about, which is taking out liquidity once without then creating a second break. So if we had a second break here, I would have then classed that as bearish. But what we had instead was price taking out liquidity right here, then continuing to take the high once again, okay? And that's essentially how I determine my daily bias, guys. So don't take my word for it, go and try it on a real chart. Have a look and see how accurate it is. It's extremely accurate and it gives you a much higher probability of hitting wins in your lower time frame trades. This was how I improved my win rate vastly with my strategy. Now, for those of you who are struggling to become profitable traders, I decided to create a Discord group for you guys, and it's completely free to join. I go live in there every single day with my team and trade right in front of you live. You can learn from us. It's completely free to join. Make sure to join with the link in the description while you still can.